big issue, big danger in bond is when you cannot meet the obligations. Last week we discussed a lot of situations who bear the risk. One of the bigger risks in bond or fixed income securities is the credit risk, or we call it default risk. And now, U.S. government basically play with fire. They wait until on last day. Now you must have some opinion. Do you think the U.S. government will default this time? They will not raise the borrowing capacity.
No, I think they're just holding up on the street to the fire.
It's basically fighting. They will figure out whatever the excuse they give you. But it become a habit, Richard. It become a habit. Brinkmanship, Obviously, our media, like our TV news and also the news, kind of a little biased toward the liberal. Seems like a Republican crazy, a bunch of crazy guys, doing all crazy things. Well, they have their philosophies. They basically say that you cannot continually spend the money, as we showed you, huge. We need some kind of a cut spending a little bit. Right? They need to cut spending. You need some negotiation. Obviously, when negotiation, you cannot just my way or highway. You always both parties need to give them and take. I think they might have some kind of a last minute compromise. Then we wait another year, and then next year we start again. This is a pretty bad situation. Now, in Europe or international market, there is an insurance called credit swap, credit risk swaps, traded in London and basically it's overseas market. Basically guarantee U.S. government will not default on their treasury risks. You think it'd be crazy? I don't think the U.S. government ever will not default. But they do have those credit swaps, like insurance policy traded. And everyday price quoted now is the biggest price. It's very high, even higher than the average, like a corporate bond default. In other words, market indicates there is real possibility. There's real possibility. People are willing to pay for it. U.S. government might default. And you'll see that, they have like a jump, like 30 basis point, huge number jump. This one, if this thing can be very quick, become a habit. And any political, impasse, then people should cut down on the budget and threatening a default. And gradually, default exactly what occurred. And you will find out if people are always saying, well, the consequences of default are so disastrous. Everybody knows that. But you continue doing it, almost like crying wolf, day in, day out. And it has become a big issue. On the other hand, why Congress will stipulate that U.S. government spending cannot have an unlimited. They always have an automatic limitation. You cannot above certain amount unless Congress approves. It's a kind of check and balance. The ceiling itself. If you every time automatically kick the ceiling up open, then why do we need a ceiling? The ceiling is kind of a mechanic, a check and balance. And the U.S. government cannot spend almost unlimited. So we should be a little bit concerned about what really happened is, now it seems so obvious, so people was Obamacare, no, it's not that, it's more than that. And with the overspending part, just the overspending part need to be checked, right, on one hand. So it's needed some kind of balanced approach. So this is one event. And the U.S. The stock market is not totally smooth, as most of us don't believe U.S. government will default. We know those politicians at the last minute they will come up with some kind of saving face way to solve it, because nobody wants this time starting to really hate that. But on the other hand, if you year after year you're threatening that, as a causing a situation people don't want your treasury, consider it as risk investment. If your credit going down, last time we did this, U.S. Credit, S&P downgraded, and this time we continue to do that, U.S. government borrowing costs will go up. And sometimes, people even seeing U.S. dollar will drastically drop. You cannot just continually play crying wolf thing. But it seems we go that way. Anyway, yes.
Default means there is no money to pay their bills?
No, they do not have enough money.
Enough money.
Yes. They do not have enough money
Including the
to
assets?
pay.
No.
No, it's a borrowing. The government have to borrow and issue new loans, new bonds, get the money, pay off the previous debt. You know, you have to issue new loans, pay off the previous debt.
So how do you get to that point? Not having money, like how do you become defaulted? Like, how did
For example, now if a week later, Congress said no, you cannot lift the ceiling. The U.S. government cannot issue additional bonds to raise money. Those money are raised to pay for the debt service. You owe that credit card loan. Basically, we're thinking about is credit limit, credit card limit. The debt limit, basically the credit card limit. We cannot borrow, allow borrow. So there is a point. Why we have a debt ceiling, you have to put a limit on it. But if any time just easy to kick up, then why we need a ceiling on it? Because there is a check and a balance on it.
So when was the last time that we didn't have any debt?
Oh,
Always.
we always have debt. But since the debt, or the highest debt we saw is during the Second World War.
And what's the lowest?
The lowest, but after that, you'll see them going down.
Wasn't it good during the Clinton administration?
Clinton administration benefit from the George H.W. Bush, 41, raised tax rate. So he lost his presidency, but U.S. Tax rate, corporate tax, benefit from it. So U.S. fiscal policy sometimes is not like immediate. So like tax policies, you might benefit your successor, right? California is doing quite well because of the tax revenue. Most California companies are doing well, and so you see Sacramento is in good shape. Right?
Maybe they should-
Jerry Brown did a
They
great
should
job.
send Jerry Brown as a consultant to the U.S. government. Straighten out.
Jerry Brown. I'm still thinking about, you cannot go totally. Jerry Brown obviously is a kind of is not strictly liberal in a sense. Like he knows how
He's both
kind
sides.
of both sides. Yeah, we probably need like both sides, like Clinton type in the middle. Jerry Brown. You cannot just go extremely. And Obama is really goes very extreme to that. The spending is unbelievable. In the future, we're looking back, probably. The question is, when is the most expensive program we ever had? Obamacare. We might end up with that huge.
Yeah, but have you looked at those programs, like the deductibles now, the in-hospital deductible
No,
for
I don't.
everybody is like 10% or 40%, and it used to be 0. So if you have a car accident and you're in the hospital and it costs you $1 million, you're gonna have to pay at least
No, there is definitely,
$100,000.
there is no free lunch. And if you're looking at Europe, one of their biggest expenses, is free care, Medicare. But people have to wait in the line to receive the service. They take a long time because of precious sources. So you will find there are so many uninsured people who are insured. No free lunch. We have to pay for it. Yeah, but this is why I'm thinking about this money is really go to extremely expensive program.
So how come it's so expensive for the government? I would have thought the government would have been paying less money because all these people that were uninsured before, their bills had to be paid by somebody.
People just strictly not paying. And I think the one of the bigger problem of Obamacare is not still using the insurance company, the middleman.
The insurance company is making out like a bandit.
Yes, exactly. And the only way, if you can really tighten control, is squeeze all those
But they're not.
insurance.
They're
No.
gonna make money hand over
This is a
fist.
policy. This is what the policy conflict. If you pursue a socialist policy, all the way go socialist, go to single payer.
Well, that's what they're
Government
trying to
care.
do, that's what they're trying to do.
Yeah, but obviously, now we are market oriented. But the market oriented, then you have middlemen, they have to make a profit. It will end it with, when a lot of patients holding the bag for that. Become too very, very expensive. The poor people will go down. Right? Eventually, I think, the only solution will be another president come out, single payer.
Yeah.
Single payer, the government control. Government pay. Now you have all those insurance, the policy is very complicated, extremely complicated. Yeah, but that one. So up to now, we do not see although the government shut down about 2 weeks, we don't see when we'll open. But market take is in stride. It's not really overreacting on that. People are already prepared for that. The irony is a lot of government bodies really is not essential. They can shut down. So we don't have to pay them. Unfortunately, we still have to pay them.
You know
Right.
one of the ironies though? One of our friends is a government page. She's still employed.
Wow.
She's a page, she runs Spruce
Running
Coffee.
around. Government will still have to pay them, right? And on the other hand, we're looking at the BART. Anyone using BART, next week they might on strike. They the board offered them like a 10% increase for years. It's pretty good, get a job there, it's pretty good, right?
They have a really good salary.
Yeah, the salaries is all, and guaranteed 10%, they're not enough. They have more than something, sometimes. But you see, but this is kind of balance.
Well, they
Checking
gotta,
it
they
out.
gotta cover their medical bills on.
I still have one question regarding the default. So the default, you can count on assets, it's only like kind of cash they have, right? The reason we ask is because there is a kind of big news for Brazilians. The Eike Batista,
Right,
he was the seventh richest guy.
right.
And now he lost 34.
Yeah, they don't have, enough money to pay you. That's called a default.
So that means they're spending more than they're making.
Yeah, they don't have enough money to pay you. That's called a default.
Okay.
In business, that's a bad situation. Obviously, in default is not very end of the world. You negotiate with your lenders. You renegotiate, but that is a bad situation. Right? Now, when talking about default risk, we say that default risk only occurs when you borrow. When you borrow, you have a promise to go someplace. But if you look at the balance sheet on the right-hand side, in addition to the debt, we also have, it's called equity. It's called stocks. What is the biggest difference between stocks and its debt? A corporation can use debt or can use stocks. What is the biggest difference between equity versus debt?
One builds ownership in the company.
One is ownership. Which one is ownership?
Stocks.
Stocks ownership. If the company has no debt, will the company have a chance to default?
No.
No, there's no default risk. You didn't borrow any money. Is that company business failure disappeared? No, they still have business failure. But the failure will not be in terms of default. Default is promised payment. I cannot meet those payments. Okay. You think about default, in most cases, more vivid situation is you borrow on credit card, you have to pay them. If you cannot pay them, then you're default. But on the other hand, if we're using cash, if you your own money, then you don't have a default. Don't have default. It represents the ownership. It represents ownership. Now we see that the stock price then is dependent on its future dividend. Now in a bond you receive interest rate, like coupon rate is an interest rate. But in stocks, it's a dividend. It's a dividend. So we basically, it's a dividend. The dividend also will grow, gradually increase, grow. And this class, we basically looking at stock price is future dividends cash flow analysis. We are still using cash flow. But at the very end, we also study like PE ratio, etc. But mostly, we're using cash flow, dividend model. Okay. Let's look at a couple of examples now. You invest in stock. The benefit investment stock, you receive dividend. The other important one is the stock price appreciation. We call it capital gain. So ownership have two types of cash flows. One is dividend, one is capital gain. Now, capital gain usually occurs when you sell your stocks. But as long as you own the stock, you will receive dividend. Dividend is a cash flow. Obviously, high dividend, high the value, right? High dividend, high the stock value. Let's only looking at, for this class, for that purpose, looking at that three situations. The dividend is a dividend, no constant dividend, we call it no gross dividend. Then we study constant dividend. Then we study different gross dividend. So dividend model is what we do. First, let's look at zero growth. We're using D to represent dividend. Here is a very important concept. We're using D0 as last dividend. D1 as next dividend. It's different. D0 is last dividend. D1 is next dividend. Now let's look at this dividend situation. We have dividend on constant. Next, after that, they are all the same. So how long a corporation is supposed to live? Corporation is supposed to live forever. So you have an infinity theory of dividend. What is this? Now this one is the model of perpetuity. A constant dividend, dividend never grow, constant dividend is perpetuity. It's a perpetuity. Let me do this example. So the value of a price today is a dividend divided by interest rate, the cost of capital. Now, if the dividend is $10 and interest rate is 10%, required rate of 10%, what is this stock worth? Stock worth $100. See that? Just do a strict calculation. If there is no growth, no, what company is worse? Now this company basically is mature. For example, tobaccos, their dividend constantly, almost constant, never change, go forever. Let me just give you another example. You do a quick calculation. The dividend is $3. Dividend is $3. The cost of a capital is 5%. How much you pay for this dividend, for this stock?
$3
$3 dividend. Every year, $3.
divided by 0.5.
0.05.
Oh, 60.
Okay, let's see, how do you pay the stocks? Pay those no growth dividend. And this one also like a preferred stock, also calculate that. Okay. No growth. No growth because there is no growing opportunity for this company. It's an easy one.
So
Yes.
how do they know that there's no growth opportunity?
This is one type. It's one type. No growth, low growth. The growth is extraordinarily low. When the company reaches to its maturity, I'm using example like a tobacco industry. Domestically, sales growth almost zero.
So does it have to have like no growth for a certain number of years before it's classified? as
Right.
no-
Usually those companies are relatively mature. It's mature. The growth is zero. In theory, okay, we can give you those as example. Now, the most common one is not a no growth. It's called constant growth model. Here's a couple of equations I want you to make a note on it. We let G represent dividend growth rate. The dividend growth rate, G represents dividend growth rate. So $1, $1.10, $1.21, 10% growth rate. Then in this situation, D1 equal to D0 times 1 plus G. Next dividend is last dividend times by 1 plus G. A good example. If the dividend is $3 and the growth rate is 10%, how much is the second, is next dividend? It's 3.3. So D1 and D0, the relationship is D1 equal to D0 times DG. Now this one can expand. How about second dividend? Second dividend then is D1 times 1G. How about third dividend? Third dividend is D2 times 1G. So it's kind of an infinite theory. We ended with this formula. We say the price for this dividend model, which the dividend increase at the rate of G is equal to D1 equal to cost of a capital R minus growth rate, or D0 1 plus G over R minus G.
So does that mean that every year it's going to grow by
Yes.
10%?
Yes. Okay. Now, for those, here's your proviso for R higher than G. The rate of return should be higher than dividend growth rate. Otherwise, you have negative. Now, this formula will complement this. Depend on what your condition given. Let's do one exercise. So when you're looking at dividend model, first ask yourself, is that last dividend or next dividend? Next dividend using this. Last dividend using this. Now let's do our numeric example. Suppose Big D just paid a dividend 50 cents. It is expected to increase its dividend by 2% per year. If the market required rate of return is 15%, how much should you pay for this dividend? Now, which model should we use? Should I use the D1 over R minus G, or should I use D0 times 1 plus G, R minus G? Which one?
Second, 30.
It says, just pay the dividend. Just pay the dividend means last dividend, already paid. Therefore, you should be using this formula, not this formula. Okay? It's just paid. That means D0, not D1. Notice D1. D1 then D0 times 1 plus G. Okay? So calculation pretty straightforward. Therefore, you are using 50 cents times 1 plus 0.02. So the numerator part is D1. See that? D0 times 1 plus G, D1. Divide by 0.15 minus 0.02, $3.92. Now that is the example on that.
Can you do that in a calculator?
Yeah, do the calculator.
But I mean, using.
Oh, how do you do calculator? So the first one you do this, 0.5 times 1.02.
No, what I mean is using like future value, those type of things doesn't
No,
work.
you don't. We don't use it. Using the formula.
Okay.
When using formula, then you don't using the time function, time value function. No, we are not using time value. Here we have to rely on formula. So please make a note that just pay equal to D0. If they did change, suppose Big D expecting their next dividend is 0.5. In that case, you're using 0.5 divided by zero. You don't have to grow. 0.5 become D1. Right? D0, D1 do not confuse. This model, in other words, this model is a pretty famous one. This model, also called the Gordon model. Let me write it. The guy, the name is called Gordon. Gordon model, dividend model. Among all the dividend model, most commonly used Gordon model. You definitely will see type like this exercise. We'll do those exercises. Let's just find one example. Let's make sure that everybody will be able to do it. Let's do one model. I'm reading the page 171, stock valuation. Example 6.2, stock valuation. Suppose any investor is considering the purchase of a share of Utah Mining Company. The stock pays a $3 dividend a year from today. This dividend expect to grow 10% per year, and the investors think the required rate of return is 15%. So that example says that the company is to pay you a year from now, first dividend $3. Now, which equation should we use?
The D1.
D1, now go directly to D1. So using $3, so we don't using this, we're just using this, right? $3 divided by, what is the cost of capital it says?
15%.
15%? 15%, the growth rate 10%, right? So it's 0.3 divided by 0.05 equals.
For example.
So that price is $60. You pay $60. Example 2.6. So it says next dividend was a year from now, the dividend, those are you want next dividend. Now a constant growth model is also called a Gordon model. It's a widely used in dividend model. But people find out the growth rate depends on a company. Company will have like life cycles, gradually. First, it will grow very fast, super growth. After certain years, companies slow down, become more mature. So let's look at case 3. Case 3 is different growth model. Different growth in other words, they have a certain period, super growth. A growth rate, dividend growth rate, let's say 15% or 10%, 10%, every year 10%. But after 5 years, the growth rate dropped to a sustainable rate, for example, 5% forever. In that case, we are looking for using different two growth model. Two growth. One is G1, the other one is G2. And G1 is higher than G2. Super growth for a certain period, then low growth for another period. Low growth will go forever. Now, the formula is pretty For example, they say the company is assuming 3 will grow for 10% for 3 years. So D0 times G1, D1 times G1, 1 plus G1, D2 times G1, 3. Start from year 4, it will grow at a low rate forever. How do you calculate those formulas? The book provides a formula like this. One is this, and one is that. Now this one is the constant growth model. The constant growth model will happen on year end. In our early example, when we do looking at a detail, looking at a numerical detail. For example, we said that a common stock just paid a dividend $2. Dividend expect to grow 8% for 3 years, then will grow at 4 forever. So in this case, we say that the first growth rate is 8%. Second growth rate is 4%. Now, like those things, because it's a relatively small number for the fast growth, 3 years, I like you just using time value money to chart it. problem like this. I like using time money to chart it. The first one, we're using D0, 1 plus G1. How? Because it says, dividend, paid dividend is D0, isn't it? So next dividend is D0 times 1G. In real life, this one will be $2 times 1.08. See that? The first dividend. Second dividend. It will grow. Grow how much? It will be D0, 1 plus G squared. D0 plus 1 plus G squared. Or like this situation is $2, 1.08 squared. Third will be D0, 1 plus G1, or G1, cubic. 2 times 1.08 to the power 3. Now, how about year 4? How about year 4? In year 4, it says it will grow at 4%, not 8%. 8% only 3 years. So in year 4, that cash flow is D0, 1 plus 1.083 times 1.04. See that? Now this portion is, can you see that? The last one is D0, 1.08 to the power 2. What is the first? This one. This one is D3, see that? D3 times 1.04. Now, go forever, it will never change, always 1.04. Therefore, this portion, I'm going to use the constant growth model. And this portion, I'm going to be using constant growth model, which is equal to D4 over R minus G2, equal to that number. Now, what that number give us is to this portion on time 3. Now, how do I calculate the whole present value for all those cash flows? I just do one by one. D1 discount, D2 discount, D3, this one, and this. You have a 3. Calculate that. So let's look at this example. How do I solve it? Before look at this formula, okay? Do not use the formula. Before, let's look at cash flow. The first one, this one is D1, 2 times 1.08. D2, 2 times 1.08 to the power 2. D3, 2 times 1.083. Now what is that? Here's a D4. It's a D3, D4. See that D4? But we're starting D4, we're using constant growth model. D4 divided by, we're using D4 divided by interest rate minus growth rate, 0.8. And this one is constant growth model. It's D4. So if it's D4 divided by R minus G2, that value is at year 3. So using your financial calculator in this case, just calculate those 3 cash flows. 1, 2, this one, add this. 3 cash flows. You get a value of 28.89. Now I want you just trace those numbers. Make sure that you understand what the number is. Now we have a 3-year super growth. When you started super growth, we sell a lot of product. So our dividend 8% for 3 years, super growth. Starting from year 4, we go to a sustainable growth forever, lower, 4% forever. So we're using we're using the constant growth model, D4. And this one is D4 divided by R minus G2. G2 is 4%. R is 12%. 12% minus 4%, 0.08. Then this one are all discount rate. Now one way you can do it is do a calculation like this. Or you can use your financial calculator if you like to do that. Now let's try the financial calculator to do that. Do you have a financial calculator? The one way to do that, if you multiple cash flow in this situation, I'll write it down, you can write it in your financial calculator. You go to your CF keys. When I go to CF key, CF 0, 0. There's no money. CF0 is 0. CF1 is 2.16. Enter. Arrow key. CF2, 2.33.
You press CF and then 0, is that right?
You put a CF key first, CF0, right? Is 0, right?
Okay.
Enter 0.
Okay.
Then using arrow key, go down. Go down. Do you see CF1?
If you punch in 2.1.
Yeah, punch.
Oh,
punch,
okay,
enter.
I got you now.
And then enter,
Yeah, enter. You register 0.
and then arrow.
This one register, the second one is 2.16.
And then arrow down.
Arrow down. And CF2, right?
No.
Say it again. What's your question? No question? All right. Now move down. 2.33. CF2. Enter. Arrow key move down. Frequency 1 move down. Now you have CF3. CF3 is, I will add them together. 35. 3525. 3525. Am I right?
27. I think 7. Oh, 27.
35 2.
7.
No, it's 2.5 times 32.75. No, plus.
So it should be 0.27.
5 plus 2 is 7.
For 27. Last one is 7? Oh, yeah, right. So it's 35.27. And this one including this. What is this? This one is perpetuity model. And this portion is equal to D4. 12 minus 4. Can you see this?
Okay.
Because starting from year 4, go forever, the company dividend will be constant at the 4%, go forever. So we're using that perpetuity model. In that model to calculate 4. But that number will have a value at year 3. And this one is very similar to our deferred annuity product. We always have 1 period, right? Deferred annuity starting from year 5, the number is 4. Starting from year 10, the number is at 9. always lagging one period. Yeah, I would highly recommend you do something like this when you do your sample midterm like this. Now, you say, I don't want to do the cash flow analysis. Can I use the formula? Yes. Here's the formula. Now this part is for the first three super growths, G1. This part, what is that? Oh, this part is the constant growth model. See that? E4 R minus G. Here n equal to 3. It is constant. 1 plus R 3. But I find this model is more confusing than easy to understand. Right? This one, if you plug those numbers in, the number can be quite complicated calculation. I will prefer you to do the cash flow analysis like you use this. To me, this one is much easier. Okay. So super growth, it doesn't matter. Usually it will not more than like 5 times. Just calculate one by one, one by one, one by one, one by one. Then you're looking at a perpetuity, will do forever, constant growth model. It's kind of the bad. Then combine those cash flows using CF key to calculate, cumulative. Okay. Well, I find this way is an easy calculation using time value.
So how did you get to 28.89? I've got.
Add them together. 28.89. In your CFT, what your number you get? 28.
Up to 3.
28. I didn't see it. I didn't see it. What your number you get?
Just cancel it.
Did you put a 12 as your cost of capital? Calculate NPV, right? Calculate NPV. 12 as your interest rate. Your NPV should equal to 28.89. Using CFT to calculate. All right. And for those, I find people I'll do that for you one by one. Oh, this class we haven't studied the cash CF key yet. Your CF key is next week's. I messed up with this one, the other one. So we haven't studied CF key here yet. In that case, we're using future value. I apologize. This one I mixed up with the other class. I apologize. CF already. All right. Instead of using CF key, I haven't teach you how to use CF key. I'm using future value. Up to now, I'm using future value. All right. Now, how do I calculate this future value? What is the first number? Let me move this one. This is not using the.
You can click on blue and then.
Okay, I'm just using this. So it's the big enough. So the first one I calculate is how much present value is $2.16 is. In this situation, I put 2.16 as my future value. Interest rate 12%. How many period? 1 period. So I compute for present value. I write it down. The first cash flow is equal to, is 1.93. 1.93. I don't write it negative sign. Okay. The next one is 2.33. 2.33 is your future value. Here is 2. Compute for present value. is 1.86. 1.86. The third one, the cash flow is 35.27. So 35.27 is my future value. 3 period. Same interest rate. Compute for present value. I get 25.10. Now I need to add them together. So here is 9. Here is 8. Here is 8. 28.89. See that? I do one by one, one by one. Do 3 times future value. Here, because I did not teach you how to using cash flow. This one was next week we started using cash flow. But when we use the cash flow, this one is much easier than this. Now we have to do like one by one, one by one, one by one. This is the gross model part. Now, the value of a company is really dependent on its growth rate. The growth rate here, the growth rate obviously is dividend growth rate. It's the type of a company making money and pay off to their shareholders. And the other one is company required discount rate R, these two. Now, how do I get those numbers coming from? First, let's look at G. Now, remember, when we have the G, when we have the net income, income statement, net income, we pay dividend. Then the rest of it, we pay as retained earnings. Now, if you put the money back, the company will grow. Therefore, G, the dividend growth rate, is retention ratio, which is equal to 1 minus dividend payout ratio, times return on retained earnings. In most cases, people using return on retained earnings using return on equity. Return on equity, return on equity. So in that case, you have to look at the dividend. Now, since we have the model look like this. Price of stock equal to next dividend divided by R minus G. Now here we need to do some algebra. I'll do the algebra part. The manipulator algebra part. So I'll do the calculation. So we know price of a stock equal to next dividend over R minus G. Now we want to isolate. How do I get the G now? The purpose, I want to isolate the G R, right? How do I do that? First, I times both sides by R minus G. I time both sides by this R minus G. What I have? We will have P R minus G equal to D1. Everybody follow me? Algebra. This one cancel each other out, right? This one go to left. And I open this. POR minus PG equal to D1. PR equal to D1 plus PG. See that? I move this one to the right, plus, right? Now I divide it by both sides by P. So here we have R equal to D1 over P plus G. So we have attribute. We isolated the R out. We just step by step, isolate the R out. So we are looking at R, the required rate of return on equity on retained earnings, equal to next dividend divided by today's stock price plus growth rate. So we do algebra to calculate what the required rate is. Earlier, I talked to a couple of students on the possibility of a purchase of IPO. I haven't called my broker yet. Twitter, I'm not really excited, but I think of it's a good timing now to buy some IPO. Twitter is going to Twitter lately posted their IPO documentation online. You can look. Twitter losing like every year losing $1 million, continuing 2 years. But obviously, you need the investment banker will put a value on the stock. Okay? But there's no cash flow. What is the cash flow you have? I have no idea how they make money. Obviously, ad money, advertisement, but now you don't see it. That's just a difficult question about the IP valuation. IP valuation are totally crapshoot, if you know what I'm talking about. You have those investment bankers sitting on, put all those projection numbers, give you those numbers projected. Those are fairy tales, all fairy tales. People crapshoot. Like Facebook, are also the same situation. You cannot really justify how much you pay for that. Pay that kind of money, the price is going to jump so high. Even looking at the Googles, now Google and Apple is the story. Apple, huge amount of cash, is unbelievable. Google, wow, how many people pay like 300 something for Google? What kind of revenue they have? So people really cannot really justify it for the money, so they come up with this model. And this model, as a matter of fact, in new edition, you are using third edition, right? And I dropped this model. The model dropped. In the evaluation, they're looking at earning per share divided by interest rate. And this part is current earning per share divided. Now look what it does. This is a perpetuity model. Google is to pay the current earning forever. But that one is only very small amount. How much Google earning will be? $1, $2, this is pretty much it. Then people add another one. Another term called net present value of growth opportunity. Now this is the portion. A company's stocks are its kind of current cash flow plus future growth opportunity. That magic number. Let me tell you, that magic number, nobody can really put some kind of concrete number on it. What is Google's future growth opportunity? I don't think even they know. Then a lot of people put whatever multiply on it. So this model, I think, is the go-go years, .com, booming year. The cash flow, they only look at cash flow. They add a huge premium. They say, I pay the premium for the future growth opportunity. The problem is future growth opportunity. To be honest, everybody knows that because the company are facing uncertain economic conditions. Anything could happen. Nobody's sure what will happen, Google in the future.
But they are kind of diversifying, so that's
Yes,
kind of good
yes.
sign.
People are thinking
right?
about, wow, they might even have Google will be like a manless driving a car. You don't need to drive a car. You put a Google on it. Google drive a car for you. Yes. But those are fantasies. Not. You cannot quantify it. In other words, this type of valuation, this is net present value of growth opportunity. The problem is, how do we find those growth opportunities? It's totally unrealistic. This model is extremely bad, but also reflects reality. People are not paying for current earnings. People are paying for future growth opportunity. But what is future growth opportunity? If you're optimistic, you think about, what? 100 million, 100 trillion, whatever number you put in. But in real world, that actually is exactly what people are doing. They put a huge amount of money, people are willing to pay for it, is for its future growth opportunity.
So are you talking about just the high-tech computer stocks? Because in
All
one-
stocks, they think they are the growth opportunity as closely related with positive net present value project, future growth opportunity.
But a lot of manufacturing companies, there's a tangible market opportunity, right?
But I'm just thinking about future growth opportunity, which is very hard to quantify,
Even if you know the market size?
even the market size. The reason is because extremely high uncertainty future situation. Who knows what happens?
But like.
In
I-
5 years, 10 years, nobody really knows. And the business, in a lot of situations, is a part of risk, is inherent uncertainty. That kind of model will allow people, sometimes, people are very optimistic. During optimistic, people put a huge amount of money on the stock price. Is due to this part. And this part is traceable. We're looking at companies' earnings. Right? So I'm going to totally skip the example of net growth model. That one's never worked for. I think the new edition already jumped. We complain a lot of times that we should not use those models. Now, this leads to, those are the ones. Leads to the price earning ratio. Now that is useful. This model, price earning ratio, first let me explain what that means. Price is today's market price. Earning is annual earning, last year earning. Those are all traceable.
Like in stock?
Yeah, stock earnings. Yeah, stock. How many stock? How many or what company stock price is? Okay. What is your earning per share? Now this price earning ratio, if people like use it, is what we usually call comparables measurement. Those are we call
Is that something that can be compared with another company?
that one leads to discussion of how to price it. Now, real estate, it typically comparabilize. So real estate said, oh, I'm going to buy a house in Belmont, $1,600 square foot, single, 3-bedroom, 2-bedroom. What we're looking at the market, same square foot, same facility, costs, let's say, $1 million. Well, your house is $1 million. See that? How many square foot per foot? How much dollar per square foot? Compare. Now, this is in Belmont. You have this price. Now, this one only true for Belmont. This ratio cannot be directly applied to, let's say, New York, or to Florida, or to Arizona. The same thing is true is for the EPA ratio, PE ratio. Some PE ratio is low, some PE ratio is high, but this gives you a sense. This ratio or give you a sense of expensive or less expensive. Now let me just give you, this is looking at the PE ratio is equal to price per share divided earning per share. Let's look at a common stock example. Oh, but before, I'll jump to the price. I'm coming back to this. I should have example. Okay, let's look at this. This is a gap a couple of years ago. Daily trading price is $25, low is $18. This is GPS, gaps, stock symbol. Dividend, 18 cents. This one, current dividend yield, current yield. Peak ratio, 18, see that, 18? PE ratio, 18. Now, what is earning? What's company's earning? Now, like you're looking at the PE ratio and go back, look at earning. It's easy to calculate. PE equal to 18, and we know the price. We're using closing price 21.35. 21.35 times E equal to 18. E equal to 18 divided by 21.35. And do a quick calculation for me. Do you have a calculator? 18 divided by 21.35. What is earning?
0.84.
Today?
0.84.
0.84. Now this is their earning. Now 18 is commonly people use market average. It's 1820 is most common, 1820. Currently S&P 500 I think is 18. Now I need to go to
So the earn is 0.84
0.84 is equal to earning per share.
or earnings per share.
84 cents per share. 84 cents per share. Now, remember, let's go to Yahoo Finance now. Now when you look at some real data.
So these PE ratios don't.
That PE ratio, I will tell you, PE ratio 18 to 20 are considered market average.
But it doesn't vary by industry.
Or it varies.
Yeah, it does vary by industry.
It varies. It varies. So you need to stick. You are thinking about, what is U.S. square foot average? For example, I'm just $200 per square foot. Wow, that price probably used in Denver. This price includes San Francisco. You are talking about $400 per square foot. But that gives you a sense. So let's learn a couple of things of PE ratio. You need real data. I'm going to use real data. And looking at a couple of companies, looking at a PE ratio. You find the PE ratio, when PE ratio is more than 20, those stocks extremely hot, considered hot stock. So let's look at Yahoo Finance. It's my favorite. Always go to Yahoo Finance.
Investing.
So let's look at a couple of PE ratio. Let's look at S&P 500 PE ratio.
Where did you click finance and then?
Finance, Yahoo. Yahoo Finance.
It's my homepage.
Yes, you're just looking at any page, you will be looking at some basic numbers. So do we have PE ratio here? Let's look at
Yeah.
our company. Now, I'm going to looking at Intel. Looking at where's the PE ratio? First page here, PE ratio. Intel currently PE ratio is 12. Intel, you pay 12 times what earning. You think 12 is high or low?
High.
Low.
Low?
18 to 20
18 low. That one showed you. It showed you Intel is not so hot. Stock not hot. Now I put this stock. Let's look at Google.
So what did you say?
Now, you see, now I give you I say 20 is the market average. 18 to 20 is market average. Intel is 12. You pay 12 times your current earning. Let's look at Google. Okay, well, Netflix also huge, extremely high.
That's high.
25. Google is high, low,
High.
very high. 25. Okay, now let's look at Netflix. Netflix. It's NTFL. Yes. Am I right? No. Netflix. I'll spell it.
There it is.
Flix.
NFL.
NFLX. How much?
396.
396.
Highly speculative. This this stock is highly speculative. Very hot.
That means it's good to invest.
No, it's very hot. The units of, I try to give you, I'm using this word, it's comparable measurement, okay?
Okay.
So I'll tell you, wow, San Francisco house, you know how many square feet it put? $800 per square foot. I'm not saying it's a good buy. I mean, there's a huge demand for the housing living in San Francisco, and this one is extremely huge.
So you could be
Okay.
buying.
Now,
something
Intel,
extremely
you know it's a good
expensive.
company, isn't it?
Yep. Definitely.
People pay only 12 times its earning. So Intel stock is not extremely hot.
And there's also not a lot of risk with it.
This will show you Netflix is actually quite good stuff. Quite good stuff. Now, if you look at Apple, let's look at Apple. Apple is currently suffering AAPL. It's Apple stuff. See? Cool. So you can argue, though, a lot of analysts, they should buy Intel Apple. It's cheap. Because it's earning that it's cheap. Isn't it?
Yeah, I believe.
Yeah, people are, some strategies thinking about, like Warren Buffett. He'll consider those a good buy. Anything above 20 is too expensive. But that theory cannot use in person. Yeah, San Francisco house is very expensive. Netflix, Netflix, they are, like Amazon.com also extremely high. But the potential is still huge in it. But why I want to show you the PE ratio? PE ratio is a comparable. You just similar, those kind of similar company. Which company is hot? People all totally ignore what a company cash flow is, isn't it? They're just thinking this is a hot stock. It's exactly, I'm saying Twitter will look like this. My guess at Facebook, you can check Facebook, also more than 12%. Look at, let's look at Facebook.
That's Franklin for me.
That was, yeah, Franklin Covey. So,
Too late. But on some, anyway.
Facebook. Yeah.
Oh, 200.
228. Now those are very speculative. Its current earning is extremely low. Currently it doesn't make a lot of money, but people think the future growth opportunity are huge. So I think a comparable measurement like PE ratio give you a sense of this company, the stock, are they hot or not? They are particularly high-tech companies full of speculation. Those stocks because people have high expectation to it. So pay so many bid, so many demand to make those price so high, the current earning never justify. And those stock, it should not really using cash flow analysis analyze. Our cash, particularly the dividend model, our looking at like Intel, looking at GE, those model, more the cash flow model, is more predictable. They don't have any variations. But companies like Netflix, Facebook, and Twitter have no idea what a company is. But I'm thinking they are doing quite well, right? Doing quite well. It seems like it become a future domination. Even look at Amazon.com, their earnings pretty bad. Right? But people still think that company can make money. There are certain people just like in Bay Area, where people like just invest in those stuff. And Facebook didn't suffer a little bit. So you always see always the pattern like